Have you ever watched a stock price just go completely wild, up and down day after day, and just thought to yourself, what is this company actually worth? How do the world's best investors manage to cut through all that chaos to figure out a company's true underlying value? Well, today we are prying open their playbook to find out exactly how they do it.
All right, let's get right into it. The whole idea really comes down to this one central conflict. Over on the left, you've got the market price. It's messy, right? It's driven by news, by fear, by excitement. It's all over the place. But then on the right, you have intrinsic value. That's the stable, logical, true worth of the business itself. And that's the number that really matters.
And this simple but brilliant idea, finding that gap between the noisy price and the real value, is literally how legendary fortunes are built. When you hear Warren Buffett talk about buying dollar bills for 50 cents, this is exactly what he means. So our mission here is to figure out, how do you find that dollar bill value in the first place?
Okay, so let's start at square one. Before we can even dream of calculating anything, we have to get crystal clear on what we're actually looking for. What even is this elusive true worth?
And here it is, intrinsic value. It's not about what's popular or what's trending on social media. It is the real economic worth of a business. And it all boils down to one single thing: its ability to generate cold, hard cash for its owners over its entire lifetime. Seriously, everything else is just noise.
So now that we know what we're trying to find, the next logical question is, how? How in the world do investors estimate that future cash-generating power? Well, they use a primary tool that's really considered the gold standard in the world of finance.
But before I even give you the fancy name for this method, let's just sit with this idea for a second, because it's powerful. Just think of a business as a kind of money-making machine. Its total value is just all the cash it's expected to produce over its entire life. But, and this is the key, a dollar you get 10 years from now isn't worth the same as a dollar in your pocket today. So we have to discount all that future money to figure out what it's worth right now. That's the core of it.
And that simple idea leads us straight to the famous discounted cash flow analysis, or DCF. Now, it sounds complicated, I know, but it's really just a three-step dance. First, you have to predict, and yeah, it's a prediction, how much cash the company's going to make over the next few years. Second, you choose something called a discount rate. Just think of this as a penalty you apply to future money, because future money is always riskier than cash you have today. And finally, you just do the math. You pull all those future cash values back to the present and add them up. That final number, that's your estimate of intrinsic value.
So right about now, you're probably thinking, awesome, I've got the formula, I'm ready to go. But hold on, this is exactly where so many people get it wrong. Just when you think you've found the one true answer, you run smack into the biggest flaw in this whole process.
Yeah, DCF is a total double-edged sword. On one hand, it's fantastic because it's based on the real economics of the business, not just market hype. But on the other hand, it is incredibly fragile. If you change one tiny little assumption in your model, say you bump your growth forecast from 5% a year to 6%, the final valuation can swing wildly. It's like a Jenga tower. One wrong move, and the whole thing can come crashing down.
And this is maybe the most important piece of wisdom for anyone trying to do this. A DCF model gives you a guidepost, right? A valuable point of reference, but it is never, ever an absolute truth. And treating it like one is, frankly, a recipe for disaster. So if the gold standard method has this huge flaw, what do? Just give up? No way. Smart investors know you can never rely on just one data point. Instead, they build real, solid conviction by looking at the problem from a few different angles.
The first tool they use is called comps. It's kind of like checking the Zillow estimate for your house. You just look at what similar houses on your block have sold for. With companies, you look at their direct competitors and ask a simple question. What is the market paying for their earnings or their sales? It's a fantastic reality check.
Next up, you can look at something called precedent transactions. Now, this isn't about stock prices. This is about what a real-world buyer, another company, has actually paid to acquire a similar business outright in a merger or an acquisition. This gives you a really valuable clue as to what a professional buyer might think that company is worth in a takeover scenario. And finally, for certain types of businesses, there's asset-based value. For a company like a bank or a real estate firm, you can actually get a pretty good estimate of its worth by just adding up the fair market value of all its tangible stuff. Now, this is less useful for, say, a software company where the value is all in code, but for asset-heavy businesses, it's another really important piece of the puzzle. See, the goal here isn't to find one single perfect number. The goal is to see if you can find a consensus. It's called triangulation. If your DCF model says a company is undervalued and the comps suggest it's cheap compared to its peers, and you see that similar companies have been bought out at higher prices, well, that's when you can start to build some real conviction.
All right, we've made it to the climax. You've done the hard work, you've run the numbers, you've triangulated a value. But listen, finding the value is only half the battle. The real secret, the single most important rule in all of investing, is about how you act on that information.
So let's keep it really simple. Let's say, after all your hard work and analysis, you confidently estimate that the intrinsic value of a company is $100 per share.
So, do you buy it if the stock price is at $95 or even $90? Absolutely not. A disciplined investor sets a maximum purchase price that is significantly lower. In this case, maybe $70 or even less. That gap is everything.
And that gap has a name. It's called the margin of safety. And it is, without a doubt, the most powerful concept in value investing. It's a buffer. It's a cushion. It's your protection against the one thing you can be absolutely certain of, that your own forecasts and your own judgments are going to be wrong sometimes. The margin of safety is what separates investing from just plain gambling.
Okay, so let's bring this all home. We started with this mystery of how the best investors seem to just know what to do. Now we can connect all the dots and see the whole picture. And here it is. The real secret to buying dollar bills for 50 cents. It isn't some magic formula you can just plug into a spreadsheet. It's a disciplined process. It's about estimating value from multiple angles and then, and this is the hard part, having the patience to only buy when you have a massive margin of safety protecting you.
And this, right here, is why this all matters so much. Because understanding this framework, valuation, triangulation, margin of safety, it fundamentally changes your entire relationship with the stock market. You stop guessing where a price might go tomorrow, and you start investing in a business based on what it's actually worth today.
So we'll leave you with this final thought. Just knowing this framework, that's the first step, and honestly, it puts you way ahead of the crowd. But the real challenge isn't doing the math, it's mastering the mindset. You have the framework now, but the real question is, can you master the discipline to actually use it?